Warren, you measure Berkshire. This is from William Bernard of Colleyville, Texas. You measure Berkshire's corporate performance based on growth in book value per share. The table on page 103 of the annual report shows book value per share has grown at less than an average 12% a year for 9 of the last 11 5-year periods. Yet in your last annual letter you state, quote, the SP 500 earns considerably more than 12% on net worth, and then you say that seems reasonable for Berkshire also. Why do you say that, given the past record showing that Berkshire has not been earning that much? Or is it that you expect to earn that much, recognizing that it is not assured in the future?
Yeah, it certainly is not assured in the future. And the last 10 or so years have not been the best for business generally. But if the stock market continues to behave in 2013 as it has so far, this will be the first 5-year period where the gain in book value per share has fallen short of the market performance, including dividends, of the Standard & Poor's. And that won't be a happy day, but it won't totally discourage us, because it will be a period where the market has gone up in every one of the 5 years. And as we've regularly pointed out, we're likely to do better in down years, as we did in 2008, for example, which is the year that gets dropped this year. We're likely to do better in down years relatively than we do in up years. Charlie, how do you feel about the prospects of? I should point out, incidentally, that we use book value because it's a calculable figure, and it does serve as a reasonable proxy of the year-to-year change in the intrinsic value of Berkshire. If we could really give you a figure for intrinsic value and back it up, that would be the important figure. As I pointed out, if we gain 1 million policyholders at Geico, that actually adds $1.5 billion to intrinsic value, and it doesn't add a dime to book value. So there is a significant gap, which is why we're willing to buy in stock at 120% of book value. There's a significant gap between the two, but book value is a useful tracking device. I should point out also, I did this in the annual report in respect to Marmon, when we buy the ISCAR stock, which we pay about $2 billion for, the day we buy it, we mark it down in terms of our book value by roughly $1 billion. So $1 billion comes off our book value for making a purchase which we regard as quite satisfactory. And so there are these distortions that occur. But in the end, we have to do better for you than you would do in an index fund. And if we don't, we aren't earning our pay. And I think we'll do that in the future, but I don't think we'll do it every year, and we've proven that in the last few years. Charlie?
Well, I confidently expect that Berkshire is going to do quite well over the long term, and I don't pay much attention to whether it's 5 years or 3 years, or I think we have momentums in place that are going to do okay. Of course, we won't do as well in the future in terms of annual gain averaged out, because our past returns were almost unbelievable. So we're slowing down, but I think it'll still be very pleasant.
At 89, Charlie is not really concerned about this stuff year to year. I mean, he's taking a longer range view.
I'm trying to take care of my old age, which might come on at any time.
I haven't noticed it. Okay.